Hello everyone and welcome back again to my channel SNS Study Station. So this is Sana Naim and today I am starting new topic with you. We'll be discussing about capital budgeting. The topic is capital budgeting. Okay, we'll see what does that mean, what is capital budgeting, why do we need it, what is its features, process and most important techniques we will see. Okay, so today we are covering only the theory part. Then later we'll see about the techniques, problems we'll see on the techniques of this capital budgeting. Okay, so from the next session we'll see problems, but today we'll see just theory. Okay, so we'll start with capital budgeting. So there's a term known as budgeting, budget. Okay, what do you mean by budget? If I ask you what do you mean by budget? Suppose you have money. Okay, you have, let's say 1000 rupees. Okay, you got pocket money as 1000 rupees and you want to spend it somewhere, you want to use that money. Okay, so you can buy anything which you like, or you can have some services. Okay, whatever you like, you can buy those products or services, or if you want to save it, simply you can save it also. Okay, but you cannot spend more than 1000 rupees. You cannot spend more than what you have. That is what budget is. Means we have to see what we have. First we need to see, we need to check how much amount we have. Then only from that amount we can invest it. We cannot invest more than that. So capital budgeting, when we talk about it, capital budgeting means budgeting the capital. When we will have capital, how we are going to use it, how we are going to spend it, where we are going to spend this capital. Okay, capital, I think you all know. Okay, the huge amount which is required to start any business, or whenever we want to do any reconstruction, restructuring of our business. So how much the amount which we need, that's a huge amount. There is capital. So how we are going to use that capital, where we are going to spend it, that is what capital budgeting tells us. Okay, earlier we have seen that time value of money, those chapter you have seen, those topics you have seen. Then you have seen about cost of capital. Okay, means money value changes as per time, and then whenever you are going to collect money, you are going to arrange money for your business. You don't have money. Okay, you don't have enough money for your business and you want to start, you want to open something new. So for that you require huge amount, so you can collect it. You have various options, that all we have seen. What are the options we have, what are the sources of finance that we have. So then what is the cost of each source of finance? If you collect money from shares, from debentures, from loans, if you borrow, so what will be its cost? That all we have seen. Now we have money. Suppose, let's say we have collected money. Where we are going to spend it, how we are going to use it. Okay, so capital budgeting is the process of evaluating investment and huge expenses in order to obtain the best return on investment. Okay, so when we have money, we'll have various options where we can spend this money. So those all options we have to evaluate. We have to evaluate which one is the best option, which will give us best return on investment. When we are spending money somewhere, that should give us, if we are spending 5000 somewhere, that should be worth 5000 rupees, correct? So what all options we'll have, that we will evaluate to check what is the best, which one is the best option, where we can put our money, where we can invest our money. So it is basically long-term investment decision. Capital budgeting is nothing, just long-term investment decision. Investment, when we have to invest money, we have to take any investment decision. We have money, we have to spend, we want to spend it somewhere, and that is for a long time period, because as capital word is involved here, capital is a huge amount, so it is for long time period also. Okay, so it is not just for within 1 year, 2 years, 3 years, no, it's 5 years or more than that. Okay, so when we are going to see that, when we are going to take some long-term decisions, there are two things we have to see. First thing is more return. Second thing is less risk. What does that mean? The option in which we are investing our money, it should give us more and more return. Okay, and not just return, we should see the less risk should be very less there. Okay, what all options we have? Suppose we have to 5 options available where we can invest money. So we have to see, first we have to check which option is giving us more return, then we have to see which option has less risk also, because it's not like one option is giving you more return than all the other options, but there's a huge risk involved. Suppose you are not going to get your money, there's no guarantee of getting your money back, then what will you do? So you have to see these two things. That is what capital budgeting is. So we have some examples. When we have to take any investment decision that is for long time period, expansion. When we are expanding our business, okay, we are making it huge, then we can spend money. There we have to take investment decision, whether we have to expand it, how much amount is required, how we are going to do it, all these things we have to check. Acquisition and diversification. When a company is acquiring any other company, it is taking over any other company, or it is going into new business, diversifying itself. Okay, it is going into completely new business, which it was not doing earlier. Then we have to take investment decision, long-term decision, because in business also, you know that if you start any business, so it will not work out for you from the first day. You have to wait 1 year, 2 years, 3 years. You have to wait for a few years for making it work. So for those 1 or 2 years, you have to invest money. Don't expect profit. Okay, that is why these decisions are for long time period. And replacement of long term assets. We have to, whenever we are replacing any long term asset can be any fixed asset also, like land, building, these also comes under asset. We have to replace that. Okay, or any machinery is there which requires huge cost, we are replacing that. Then we need to take investment decision. Big assets we are purchasing. Okay, any asset which is very big we are purchasing, we are taking decision of purchasing it. Or R&D, research and development programs are there. For these things we can take investment decision. We have to take investment decision, that is for a long time period. Now let's see features of investment decisions. Features of capital budgeting. Huge funds. As earlier only I told you that huge funds are required whenever you have to take a long-term decision, that is investment decision. So huge fund is required, huge money is required. Capital budgeting, capital is itself a huge, it refers huge amount. Investment in long-term assets means the place where we are investing, it is not just a short asset. Okay, it's not a current asset that is giving us benefit immediately. No, it is a long-term asset. In future years, future benefit, third point itself is a future benefit, means it will not give us benefit immediately. In future it will give us benefit. Today if you have purchased any building, so from the first day it will not give you benefit. When let's say if in that building you will open your business, then later it will give you benefit, or you will give it on rent, then it will give you benefit. So first you have to take it, you have to make everything ready, make proper arrangements, then only later it will give you benefit. Complex decision, these decisions are very difficult to take as huge amount is involved. It is for a long time period, it will not give you benefit immediately, it will give you future benefits. That's why complex and cannot be reversed or withdrawn. Once these decisions are taken, it cannot be reversed or withdrawn. Okay, once you have purchased let's say you have purchased any machine. Okay, you have purchased a very big machine, it requires huge cost, so you can sell it if you don't require it, but then it will be second hand. So once these decisions have been taken, suppose you get your house painted. Okay, you got a painting in your house, so for that you spent huge amount. Now that how will you reverse it, how will you take your money back? Okay, so these type of decisions cannot be reversed. Once money is invested in it, it cannot be reversed. That's why we have to be very cautious while taking these decisions, because it cannot be reversed. Okay, so these was about the features. Now let's see the process. Project generation. First thing, what is the process? First thing is we have to see what are options available to us, what are the projects in which we can invest. Then we have to evaluate each and every project. This is the first stage. This is the second second step. First we have to see what all options we have, then we have to evaluate each option, then we have to select. Third point is we have to select 1 or 2, or depends on our investment, how much money we have, based on that we will select the project where we will invest our money. Execution means here at this stage we will invest our money there, and the last follow-up, we have to check whether everything is going according to our plan or not. What we have expected means whenever we will take any investment decision, so we will expect a return. If we are investing 10,000 here, so maybe 11,000 or 12,000 or more than 10,000 we will get. So that return we are getting or not, we have to follow up, and then this process continues. Whenever any long-term decisions has to be taken, capital budgeting process involves all these 5 steps. First we have to see the project generation, what are the projects available for us, then we have to evaluate each and every project, then we have to select, then we have to execute means invest money there, and then follow up. So these are the things. Now techniques, on these techniques we'll see numerical problems. So techniques, basically it is there are 2 techniques, mainly it is categorized into 2 parts: traditional techniques and then modern techniques. Traditional techniques are those techniques, I'll tell you one main point, that is time value of money is not considered here. Time value of money is not considered, and in modern techniques here time value of money is considered. Okay, time value of money, what does that mean? We have seen that topic. If you have not seen that what is time value of money, if you don't know about it at all, just go through the playlist and see my video where you can get an idea about it. So time value of money means the value of money changes as per the time. As soon as the time passes, its value changes. So traditional technique do not consider time. Here we will be having payback period and accounting rate of return. These 2 methods we will be having. Then in modern techniques, here we will take into consideration the time value of money. So here we will be having 3 methods: net present value, internal rate of return, and profitability index method. Okay, so these are the methods which we will see. Traditional techniques, payback period, accounting rate of return. Modern techniques, it involves net present value, internal rate of return, and profitability index method. On all these methods we'll see problems. So we'll start the problems with the next video. So stay connected. Thank you.